This is what I'm going to be talking about very broadly, really just to offer some thoughts, some recent data on what we see going on in the market, really around investment activity and pricing, something on the economic and occupier markets, a look at revisiting the investment rationale for the logistics sector. There's quite a lot been spoken about this. The title of the session is it going to rise up the wish list? We think it has and we think it is. Although the evidence, transactional evidence for that is perhaps not yet as robust as we might think. I'm going to say a little bit about online retailing, and if I may be allowed a quick plug, there is a research paper on your chairs that I would encourage you to take away and read at your leisure, and then offer a few concluding points for the panel to get their teeth into. So, investor sector preferences. Is it rising up the wish list? Well, this is what you told us, or you and others like you told us at this point last year in our investor intentions survey. You can see from that industrial logistics was even then already on its way up the wish list. There was a significant increase in expressed intention to target the industrial logistics sector, to a point where it was on a par with shopping centres at this point last year. Has that happened? Well, not to an entirely convincing extent yet. This is what happened to turnover in industrial and logistics property across Europe last year. About €8.5 billion were transacted, which, as you can see from that, is down very slightly on 2011, but in the same sort of range as we've been seeing in the post-2009, post-Lehman's era. So it's doing okay, and broadly in keeping with what we're seeing in commercial property transactions generally. This is all sector commercial property investment. The pattern will be familiar to you. Last year, 2012, the full calendar year, we saw about 120 billion transacted, which uncannily is almost identical to the 2011 figure and up a bit on 2010. So there are some look like reasonably well-established patterns in terms of overall liquidity in the market. But perhaps we're seeing some geographic shifts within that, and certainly it'd be interesting to hear the panel's views on why these are happening and whether they're going to continue happening. If we look at the pattern of industrial and logistics investment across Europe over the past 2 years, clearly the UK is still the dominant market at over 30% over 35% of transactional activity last year. The big story there in terms of differences between those two charts is Germany. Now there are some specific one-off reasons behind that, but equally we know that in terms of economic fundamentals, Germany is one of Europe's stronger places at the moment. We also know that in terms of its contribution to investment in this sector, relative to others, it's punched below its weight for some time. There are reasons for that, but certainly on the evidence of last year, perhaps that's beginning to change. The other points to note from that, not surprisingly perhaps, Southern Europe in particular, but CEE as well, diminished in terms of their contribution to overall activity last year. Those two places between them are about 14% of turnover in 2011 and about 9% last year. Again, are we seeing a shuffling of the pack? Are we seeing discernible patterns coming through in terms of the geographic structure of investment in the sector? And why are people buying it? Well, it clearly isn't for prospective rental growth. It rarely is in the industrial and logistics market, but clearly we're at a point in the cycle where there is little rental momentum. On our prime rent index, industrial and logistics rents fell by about 1% last year, which is, as near as makes no difference, flat. But that isn't unique to the sector. That's a general feature of the market at the moment. If you look at the pattern of change across the three sector indices, the office index didn't do very much to speak of last year either, and the only place where we recorded any strong rental momentum was the prime end of the retail sector. So very clearly the economic conditions that we're in at the moment are stifling rental growth. And I think it would be reasonable to expect, certainly in the short term, that will broadly continue to be the case. This is Oxford Economics' current view on GDP growth in Western Europe. you can see that this year marginal growth expected, but it's really 2014-15 before we start to see more convincing signs of recovery and growth in the European economies. And even then, as you can see, that's nothing like what we saw, for example, in the late 90s or even the early part of this decade. So demand side conditions are probably not going to become conducive to rental growth anytime soon. And we have seen the impact of that in terms of leasing activity. The 2012 number here is still needs a bit of refining, but it's likely to be significantly down on 2011 and the second half of the year, particularly weak in that respect. So, we are seeing weakness from an economic fundamentals and demand point of view. But that's a very aggregate picture, and there are significant differences in terms of the pattern of outlook around Europe. I put this there just to illustrate the scale of expectations. I don't think the pattern will surprise you. Southern Europe economies generally still expected to contract over this year. A number of, and particularly the bigger Western European markets, either expected to see growth of close to zero or weak growth of around or just under 1%. And the areas of growth, of stronger demand from an economic point of view, principally concentrated in parts of CEE and what I might call the sort of expanding European periphery. Now, does that have a bearing on investors' thoughts and behaviour? Does that perhaps underpin or produce a catalyst for further changes in the pattern of investment across the market? I'll be interested to hear. If we have a quick look at the UK, clearly those take-up trends that I showed you earlier are not universal by any means. If we look at the larger end of the logistics market, the 100,000 square feet and above space, you'll see that actually that increased in 2012 to some way above its long-term average and the second highest number in the past 5 years. So clearly there is demand momentum in some places. And the other thing I'd draw your attention to here is that 60% of that was new, not previously occupied space. And nearly 75% of that was build to suits. So we're starting to see or maybe we're some way into seeing a sort of polarization in the pattern of demand and procurement. Very, very strong focus on good quality new space, which is something I'll come back to in a minute. And that is having a bearing on patterns of supply as well. If we look at, again, this is the UK, if we look at the overall pattern here, total availability is not far off half what it was in 2009. The bulk of that is second-hand, much of it perhaps not entirely suitable for occupiers' needs. And relatively little of that is good quality new space available in the market. So there are parts of the market where it isn't that easy now for occupiers to find large volume, new, well-specified space in the places that they want it. So, that you would expect to have an impact on values and investor intentions. Within those overall numbers, there's quite a lot going on in terms of the way occupiers are thinking about their space demands and managing their existing operational space, which we don't have time to go into in detail, but just to give you a flavour of that, we've seen already demand conditions will reflect a generally slow economic recovery. That in turn is shortening business planning horizons and generally in Europe, although this seems to be less the case in the US, producing greater need for lease flexibility. There's a whole lot going on underneath that across various different dimensions, some of it driven by a very strong imperative for cost control, others, in other cases, that leading to an opportunity to look at the efficiency, the location, the occupational terms, the ability to accommodate greater process complexity and greater mechanization. So there are a lot of things that occupiers are actively thinking about and doing at the moment that we think will alter the pattern of their location and the types of space that they target. We're also seeing globalization, internationalization of the 3PL sector. We hear quite a lot about this, but this is still a fairly fragmented sector. Last time I looked, the top 5 companies in that sector at a combined market share of well under 20%. So there's scope for consolidation there. There is scope for network building, which again will focus demand on the best strategic locations. So we're seeing a situation where there is a lot of second-hand space available in the market. Not all of it is suitable. We think that will lead to, I've called it a Premier League, but maybe it should be a Bundesliga of logistics locations and assets emerging that are very strongly the target focus of occupiers. So that's a bit on the occupational market. So just going back to the investment rationale, the sorts of numbers that we've seen over the past year or two have maintained broadly the position of the sector in the suite of investment around Europe. So industrial logistics have hovered around somewhere between 8 and 10% of the overall market, reasonably consistently over the last few years. So the kind of strong investor intentions towards the sector that we saw at the beginning, perhaps not yet manifest in activity. So why do people buy this stuff? Well, the traditional rationale, we all know, is income. And on that criteria, the credentials of the sector are pretty well unarguable. If you look at the pattern of income return across the three main sectors over the last decade or so, the industrial and logistics sector provides an income return that's 120, 130 basis points higher than the other two main commercial sectors on a reasonably consistent basis. And if we look at the pattern of yields and pricing and relativity with bonds at the moment, you know, that income profile perhaps looks even more attractive. And there's a differential of over 600 basis points at the moment between average prime industrial yields around Europe and 10-year German bonds. Now, you can argue that 10-year German bonds are artificially low at the moment, and you'd probably be right. But nonetheless, that's on the face of it, a pretty attractive spread. But clearly, that in itself doesn't appear to have been enough to encourage investors to migrate into the sector in huge numbers. So, again, if I could be permitted another plug, what we did last year was to take a closer look at all this. And we hooked up with Mercer, the actuarial consultants, to have a look at a broader look at the investment credentials of the sector, not just against other real estate asset types, but against financial assets, bonds and equities and so forth as well. And the conclusions, and again, I'm not sure if there are copies here, but there are certainly copies on our website, so please feel free to have a look at the detail. But the conclusions were overwhelmingly positive. We looked at this from four perspectives. Income, and we've seen the results of that a minute or two ago, and industrial and logistics come out very well on that. Inflation-related returns, how far do different asset types provide some protection against or expectation of at least matching inflation? Clearly, real estate and equities come out better than bonds on that factor, and industrial and logistics, you know, has a pretty strong bill of health on that as well, particularly over the medium term. We looked at liability matching, and the sector comes out with very strong credentials, particularly for short duration liabilities such as those of fairly mature pension funds. And we looked at efficiency of total return per unit of risk, or alternatively risk per unit of return, depending on how you want to look at it. And again, it comes out very respectably against other commercial property types and extremely respectably against non-property asset types. So the conclusion we drew from that was for a very broad range of investor types and investment motives, there is a pretty strong rationale for looking quite hard at investment in this sector. And I'm sure there are questions, issues, challenges that you wish to put to the panel on that point as we go forward. Finally, we've also had a look at online retailing. There's been a lot written and spoken about this in terms of its impact on retailing and retailers, but rather less on what it might mean for logistics markets. But I think that the logic of it is fairly compelling. I mean, we know that, or we expect that online sales will continue to increase pretty strongly. Survey work that we've done suggests that retailers across a very broad range of types are actively and aggressively pursuing multi-channel strategies, to the point where almost 2/3 of them expect to regard themselves as fully integrated multi-channel retailers within a 2-year time frame. And that's a pretty big shift. And we also know that many of them are actively devoting serious, prolonged, head-scratching time to what does that mean for supply chains, what does it mean for their logistics platform. It might mean this. There are at least 10 other diagrams that I could have put up here in terms of what that might mean for the configuration of supply chains. But given that the end destination point changes from a single retail outlet to potentially multiple households or drop-off points or lockers or the local co-op or whatever it might be, there is a proliferation of end destination points. It introduces the need for significant, high throughput, efficient, close to final destination space, the final mile, as it tends to get called in the UK. So it's a reconfiguration of supply chains, and it's already a pretty strong contribution to leasing activity in logistics markets. We did a bit of a straw poll around our teams, and the evidence suggests that in quite a number of big markets, including the UK, including the Netherlands, including Poland, including Germany, you know, this sort of activity, not just from pure play online retailers, but from multi-channel retailers as well, and 3PLs acting on their behalf. This is already, you know, up to 40%, and in a couple of cases more, of leasing activity in the logistics markets, with potential for that to grow over the next couple of years. We've also directly asked retailers what do they think it's going to mean in terms of their requirements for space, logistics space, distribution space of different types as a result of their online retailing strategies. And you can see the results here. Most said they're going to need more regional distribution space, and many said they're going to need more local warehousing. And since then, I think the evidence has accumulated that local, close to final destination space, effectively what's local warehousing here, I think we'll see a surge in demand across a number of different locations, potentially on the periphery of almost any large town or city across Europe. So that is an active area of, or will become an active area of occupier demand that is not well understood or reflected in capital markets, either in terms of liquidity or pricing in Europe. It is rather further advanced in the US, and maybe there are things that we can learn from that. Right, that's almost it from me, but just to give a few hooks, and I'm sure there are plenty of other issues that you're itching to discuss. It's just clearly more than just a defensive play in a slow growth environment, although that in itself is a recommendation. But there's a kind of lingering question: how widely accepted is the broader and we think pretty compelling investment rationale for the sector, and are investors of different types actually acting on that? And from that, we know we've seen evidence, and there is plenty of other evidence out there that there is significant investor appetite for the sector. Will that translate, or how quickly will that translate, and where, into more and more diverse types of capital coming into the market? We've seen, I showed you early on, some evidence of changes in the geographic pattern of investment. Germany is certainly increasing its contribution. Is that a sustainable, pervasive kind of trend? Which markets are going to find favours with investors over the next few years? Understanding fast-moving occupier dynamics is vital. That's an assertion rather than a question, and you know, I've shown you a little bit of evidence of that. But what occupiers are doing and how they are, you know, approaching occupation of this kind of space is a very active area of attention and a very dynamic thing at the moment. And from an investor's point of view, it's important to understand that. Finally, online retailing, e-retailing, is a structural shift, a structural source of growth in the sector, and it isn't just something that's going to lead to more of the same. We think it's going to lead to demand for perhaps different types, different locations. How will that evolve? And perhaps particularly, how will deep, sustainable capital markets develop for the new products that occupiers will require from that? So, thank you for listening. Plenty to discuss, and look forward to hearing your questions.